Hey there, everyone. Welcome back. You are watching Insight. Right now, we are joined with Heather Foster with Foster Financial to always be able to talk finances, money tips, etc., etc. Oh my gosh, Heather. I mean, what we're talking about next, I mean, inflation has to be the word of the year. And for those who may not know what I-bonds are, let's talk a little bit about it. I-bonds and inflation.
Yeah, so I-bonds obviously are bonds that are issued based on inflation rates. So if you would go back all the way to last year, you would have heard me saying, like, go buy I-bonds, because at one point they were over 9% as far as what they were paying out on an annual basis. So that was wonderful. 9%. Wow. We can get 9+% on a bond. However, that meant that inflation was also above 9%. So the rates on these I-bonds, we get new rates every 6 months, and they are tied to where inflation is. What's interesting, and what we were talking with a lot of our clients about, was the expectation for this November rate. So November 1st is always a new rate, and May 1st of every year is always a new rate, Tony. We were expecting that inflation was getting curbed. What you hear everywhere is that it was going down. So we actually saw the rates go from over 9% to about 6.8 last November, and then this May it came out at 4.3. So you see that trajectory on that trend going down, because they were curbing inflation by raising interest rates across the board. However, the November rate came out, and we thought it would be lower than 4.3, and in fact it went up. So that means that inflation actually went up from those May rates to these November rates. They went up to 5.27. So I-bonds are still an attractive buy for people to have their money in a conservative stance, getting that kind of guaranteed interest for that 6-month period. So if you got I-bonds or you bought I-bonds over the last year, the thought process were that we would be telling clients to go ahead and move them out of the I-bonds and back into CDs or something that had a higher interest rate. And in fact, the I-bond rates now are competitive with CD rates at 5.27%. But that also paints a little bit of a story for us, Tony. It's saying that, hey, if May's rate was 4.3 and the rate is tied to inflation, and it went from 4.3 up to 5.27. What is that telling us as far as a storyline about what's happened with inflation from just May of this year? So in fact, did it get curbed with the interest rates going up? Or in fact, what we're seeing here, and the rates are telling you the story, Tony, is that rates went up, which means inflation went actually up, not down. So the Fed's raising interest rates are to curb these inflationary rates, but we're seeing inflation is really kind of teeter-tottering in that 4 to 5% range, which is not normalized inflation. We're looking for something in the 2 to 3% range to consider inflation under control. So it really is starting to paint a story. Again, for the investors out there, high inflation also means higher interest rates, so you can earn more on your money if you're a conservative investor, which is why we're talking about I-bonds. But also, to the truth of the story is, when it comes to inflation, and why you're hearing it talked about all over the place, Tony, is everything's costing more, right? Everyone raises rates, and we don't expect those rates to really fall. Yeah. I think they're catching up from what inflation wasn't doing for the last 15 years. So everything costs more, which then the name of the game becomes put your money to work. Don't let any of your cash sit there earning nothing, because you're truly losing money. If inflation is 5.27 and you keep your money in a savings account earning 0, you're actually losing 5.27% annually, because the cost of goods are going up and you're not keeping up with those cost of goods. So put your money to work.
Yeah, put your money to work. All things to really consider, because like you said, this inflation, interest rates, all of these things impacting us, trying to catch up with one another. So if people have questions, that's why it's important to be able to get in for that consultation, to be able to see, hey, what should I be doing next, whether or not I already have an I-bond or if I'm looking to get an I-bond, correct?
Yes.
All right. Thank you so much, Heather. We appreciate you as always. Everyone, take a look at your screen right now. You can find out more information about Foster Financial. Go ahead and reach out to them if you've got questions. We'll be back.